Hi everyone. Let's talk a little bit about operating budgets. And in some textbooks, in some circles, it's also called master budgeting. Okay, what is it? Well, operating budget is the plan for a firm's operating activities for a specified period of time. Okay, so it's planning. We also consider it the forecasted or pro forma financial statements. They are the projected financial statements of what we think will happen in the future. So instead of producing financial statements of actual results, we're putting together a plan, what we think our financial results, our financial statements will look like in the future. Okay, there's some benefits to budgeting. They help the organization by serving as a guide for where we want to be. It can help us assist in allocating scarce resources to areas of the business that upper management and management in general think those resources should be allocated to. Okay, and budgets also can foster communication and coordination within the organization. And finally, budgeting it establishes performance standards, meaning we have a projection as to what we think we're trying to achieve. So we have a sales target to hit. We may have an operating cost target to hit, and we certainly have a bottom line or net income or perhaps income from operations line to hit. Okay, now there are different approaches to budgeting. There's a concept called perpetual budgeting or rolling budgeting, and this is the idea that we prepare budgets for so many periods into the future, and as a month goes by or a quarter goes by, we open up a new quarter at the tail end, and then we project that period. So we're constantly budgeting throughout time. So we don't just do it all at once. The idea of perpetual budgeting, let's say, is every month we prepare an estimate of what we think our sales and net income will look like for the next 3 months. That would be an example of perpetual budgeting. Okay, so as one month ends, another month gets added to the end of the budget. Now, incremental budgeting is the process of using the prior month's budget to build the new operating budget. So it's very much based on the idea that says, unless we know something different, the future will be a lot like the past. And the whole idea of incremental budgeting is we try to identify what's different and then build those assumptions into our plans for the future. Okay, there's also a concept called zero-based budgeting, which is an alternative to incremental budgeting. In here we tell the management team, start from scratch and justify every dollar, justify every expense. Tell me what you need to spend your money on. I don't care what you spent it on in the past. I'm interested to know what you need and why you need it in the future. Okay? Also, top-down budgeting, that's where the top executives prepare the budget. So it's not exactly a participatory approach. It's one that says, I'm the boss, I'm going to give you the guidelines as to where we need to go and what the future is going to look like. And then, of course, your job is to make it happen. Okay, so it is an imposed budget in a top-down budgeting process. Now, in bottoms-up budget, we take the opposite view. We say lower-level managers and employees will prepare the initial budget, and since they're the ones closest to the action, perhaps their input is relevant to what the achievable goals could be. Okay, so it's connection is bottoms-up budgeting and participative budgeting go hand in hand. And it empowers employees to give them the authority to make decisions concerning their job responsibilities. Okay, let's talk a little bit about the sales forecast. Normally this is the first step, in putting together a budget. Okay, we start off with the sales forecast, and then from there we would develop the sales budget, the production budget, a cost of goods sold budget, and other budgets. Now, this is the idea in my mind of master budgeting. Some people call master budgeting and operating budgeting the same thing. It's the idea that it's a plan for a lot of different financial statements and a lot of different areas, not just sales, but the whole production area of our business, in other areas as well. Okay, so let's talk a little bit about the different budgets. There's the sales budget, and typically we would list what items we're going to sell, how many we're going to sell, what the selling price will be, and then we multiply it all out and add up all the various pieces and come up with the overall sales, overall dollar of sales and units of sales for a period. Then we put together a production or a purchases budget, which says, given that we understand the sales level, what does our production level need to be, or how much, what volume of purchases do we need to take on to support that? Okay. Then the cost of goods sold budget says, okay, well, if we know what we're going to sell, what's our estimate of what it will cost to make those goods that we're going to sell? And finally, we say, given the level of sales activity, what kind of selling and administrative cost will we incur to support that budget as well? And usually the cash budget is prepared last, where we say, given what we know about sales and all our costs, what's our projection, given where we are now with cash, of what our cash balance will look like at various points in the future? Okay, so once we put those budgets together, we'll put together budgeted financial statements, and usually the order they get put together in is the income statement first, then the balance sheet, and then the cash flow statement. Now, there is an interrelationship between the budgets, right? We start with the sales forecast, and from there, we put together a variety of others' budgets, all listed in blue on your screen. And once we know the purchasing budget and the cost of goods sold and the SG&A budget, we can then put together the cash budget. Once we know the cash budget, we know something about how much interest expense we would have. So there's this interrelationship again that says, now that we know what our cash needs would be and we may have to incur interest expense on borrowed funds, then we can finalize putting together the budgeted income statement. And once we've done that, we can put together the budgeted balance sheet, and of course, lastly, the statement of cash flows. Okay, now I just want to go over 4 main points of budgeting. First, budget. What are budgets? They're planning and monitoring tools. They're used by many within an organization for planning many resources, whether it's material, supplies, people, training needs, and there could be others as well. Corporate budgets usually are broken into manageable pieces, and budgeting could occur at a variety of levels. It could occur at the company level. That's usually the case. It may occur by division, by region, and perhaps even by department or area of the business. Quality control could do a budget. Okay, the third point. Monthly reporting of budgets at all levels of an organization is very common, and we have this concept called budget lines. That's any line item that appears on a budget, and it is very common to see a reporting of budget versus actual by month, some organizations only by quarter, and even others only by year, but it is typically common to see a comparison of budget to actual being done at an organization at a variety of levels within the organization on a monthly basis. And then my last point in this brief PowerPoint presentation is that budgeting includes sales budgets, capital budgets, budgets for an income statement, a balance sheet, and cash budgets. The whole idea is budgeting is more than just one statement. And typically when we're budgeting more than one statement, it may be called the operating budgeting or master budgeting.